Now that I've given you a brief explanation about the ABA program and what it does, let's take a look at the document itself. The title page allows a user to record general information about the farm being analyzed. You can put in name, address, manager information, etc. Also at the top, you can add some comments about the document. There's some vital information that needs to be entered on this page, and that's the projection period dates. The first date will be your statement date, which will be the statement of the assets and debts, and the start of the projection period. The until date will be calculated automatically when you enter the projection date. The other essential date is the last year-end date. The program uses this date to populate the date cells in some of the statements. For example, the net worth statement and the income expense summaries. You'll notice the year-end macro button. I'll talk more about it and what it does later on in the videos. You'll see the version number towards the top of the page. Always make sure you're using the most recent version. Again, the little red triangles. Behind each of those triangles is comments that you'll find helpful when you're completing the document. Most of the cells in this page are optional, but again, the things that must be entered are the projection period dates and the last year-end date. Now we'll look at the asset, debt, net worth section of the program. As mentioned in video 1, there are 4 general sections. They are the asset, debt, net worth section, income expense profitability section, the cash flow section, and the summary section, and that contains ratios and the financial indicators. The asset, debt, net worth section is the first of the 3 financial statement sections. This part lays the foundation for the financial analysis. It allows a user to record what the farm has, which is its assets, what it owes, which is its debts, and those as of a specified date. And that date you will have entered on the title page as the projection period start date. And it summarizes that all on the net worth statement. As we go through the various pages, you will note assets and debts as of that date. But also you'll see that you can enter expected changes to land, buildings, quota, and machinery. So the ABA program can start dealing with the cash flow aspects. The asset, debt, net worth section contains 7 pages. The land page, the building quota page, the machinery page, the other assets page, current liabilities page, term liabilities page, and net worth page. You'll see those pages coincide with tabs at the bottom of the screen. We'll go through the assets pages first. Note that the assets are at market value. So what you're creating is a market value net worth statement. The first assets page is the land page. You'll see there are 3 sections: owned land, land rented, and projected land. In the owned land section, note that you'll be entering the value without buildings, so this is land only. The essential parts are the cultivated acres and the market value. You can enter other information if you want, but it's information only. In the land rented section, again, the essential information is the cultivated acreage and the cash rent. Again, other information is for information only. Note that you can enter value of leased land. In most cases, leased land doesn't have a value to the business, but in some cases it does. And in the example here, we have grazing lease, and the grazing lease may have some value to the operator, and if they do, you'll put that value in under the leased value. The bottom section is the projected land or crown lease. So in this section, you'll record any expected changes to owned or leased land. Note that land sales are negative. Again, see the little red triangles. If you have any questions about the content of the cells or what's to go in them, the comments in the comment boxes under the red triangles might help you. The next page is the buildings quota page. You'll see there are two areas. There are the buildings at the top and the quota at the bottom. And again, in each of those areas, there's room to show projected amounts for buildings and quota. The important information in the buildings area is the market value, and that's arrived at by entering the number of units and the value per unit. You'll see in this example, we've got buildings on two quarters. On the first quarter, the buildings are valued at $400,000. On the second quarter, the buildings are valued at $100,000. And those amounts are the contributory value. An option would be to value each building independently. The risk in doing that is that you might wind up with a building value that isn't the contributory value. You'll remember on the land page, we showed the bare land value for the land. And for the real estate in total, we want the market value, which would be the value of the land as if bare, plus what the buildings contribute, which is the contributory value. And what we're showing in these examples, in the value per unit, is the estimated contributory value. Again, don't forget to enter the depreciation rate. You'll see in this example, we used a rate of 2%. Remember that this is a market value statement, so the depreciation rate that you will be entering in this case will represent what you think the buildings will lose in value in the upcoming projected year. In the projected building section, we enter what is projected for building changes in the upcoming year. And again, it can be purchases or it can be sales. In this example, it's projected that a cattle shed of 1,500 square feet will be built at a cost of $30,000. So a couple things happen when this entry is made. One is that the $30,000 additional building will go to the assets at the end of the statement, so in the projected net worth at the end of the projected period. In addition, the program knows now that $30,000 will come out of cash flow in the upcoming year. You deal with quota in the bottom section on this page. Again, the first area is for quota owned, and so you'll show the quota that's owned and value it on the statement date. In the bottom, you can show projected changes in the projected period, the upcoming year. If it's a dairy operation, and the top line under quota owned, enter TPQ. So the program knows that we're dealing with dairy quota. And if you put in TPQ, the amount of that quota will carry forward to the dairy page. Again, value the quota as you would with the buildings or the other assets. Put in the amount and the value per unit. And the program will calculate the market value for the quota. For the projected quota changes, again, if it's a dairy operation, put TPQ in the top line. If quota is going to be purchased, the amount would be a positive amount. If quota is going to be sold, the amount would be a negative amount. And again, put in the value per unit, and the program will calculate the value of the purchases or sales. Again, if quota is going to be purchased or sold, if the projection is for that to happen, then those amounts will go into projected cash flow, and the program will do that automatically. The next page is the machinery page. You'll see this is divided up into three areas: machinery owned at the top, then projected equipment purchases, and then equipment leases at the bottom. So this page works just a little bit differently than the land page and the building quota page, in that in the projected equipment purchases section, you'll only enter purchases. Sales are dealt with in the last column on the right in the machinery owned area at the top of the page. So if equipment is going to be sold, or it's expected that equipment will be sold in the projected year, you'll enter that sale as a negative amount. You can see that in the illustration. Just a point here to remember is that the sale amount should be the same as the market value. When you get to the projected equipment purchases area and enter expected purchases in the projected period, be sure to enter both the purchase price and the market value. For the equipment leases at the bottom, what you're showing is lease details. Leases aren't assets, so the amount of the lease or the value of the item being leased won't show on the net worth statement, but the amount of the lease will become a cash flow item, and you'll see this lease amount in the expense section on the crops page. The last page in the asset section is the other assets page. So all the other assets are shown here. And again, these are the assets that this operation will have on the statement date. And again, that statement date is the projected period starting date. So you'll see there's livestock, crops, supplies at the bottom on the left-hand side. Then on the right-hand side, if we go part way up, beginning other current assets, beginning accounts receivable, beginning other intermediate assets, and beginning other long-term assets. Livestock is divided into market livestock and breeding livestock. So the market livestock is things such as calves or feeders, those kinds of things. The breeding livestock, cows, heifers, bulls, all those things. And you'll see that the breeding livestock is valued a bit differently than the market livestock. In the breeding livestock, you can see that the dollars per in the valuation is the dollars per head. For the market livestock, the dollars per is actually the dollars per pound. Now the reason that this works is for the breeding livestock, we're not showing anything under average weight. So the program knows to calculate market value by multiplying the number of head times the dollars per head. When the weight is entered, such as is done for the market livestock, then the calculation is head times weight times dollars per. So if you want to value by the pound, you'll put the number of pounds in average weight, and then under the dollars per, put the dollars per pound or kilogram, whatever you're going to use. And if you want to value by head, leave the average weight column blank and put the dollars per head in the dollars per column. Then on the left-hand side, we have our crops. That's divided into grain and produce for sale and feed and supplies. So in this example, under grain and produce for sale, we've got feed wheat, canola, and seed wheat. And the value is very straightforward, just the number of units on hand. You can show what the units are, tons, bushels, whatever, and the market value per unit, and the program calculates the total market value. Same thing for beginning feed and supplies not for sale. Now, it's important to divide crops into crops that are intended for sale and crops that are intended for feed or not for sale. It's not a major distinction, but the program handles crops for sale a little bit differently than it does crops not for sale, and you'll see that when we get to the crops page. You'll also notice in the beginning feed and supplies not for sale, we're showing pasture with no amounts. The reason for this is that the inventories that we're showing on this page, the livestock and the crops, and the supplies for that matter, are the beginning inventories on our production sheets. So when we get to the livestock page, the opening inventory will be what we're showing for market livestock and breeding livestock. And when we get to the crops page, the opening inventory will be these beginning crops for sale and crops not for sale. Now, if you're going to have a commodity in the production, in the projected production, because the names that are entered on this page carry through to the production sheets, you need to name them here in this section. And that's why we've named pasture here. That naming then will carry forward to the crops page because pasture is going to be part of the crops in the projected period. Supplies at the bottom are things that are bought and brought into the farm, so it's not production. So they're the obvious things, fuel, fertilizer, concentrates, and medicine. But you may also have things such as straw, hay, even grain and supplies, if it's being purchased for use on the farm and not being produced. If we go back to the right-hand side of this page towards the top, you'll see the section entitled Beginning Other Current Assets. Things that go in this are things like cash in the checking account, cash saved, etc. You'll see towards the bottom of this little box, there are some white cells in the name section, so you can add some other current assets if you want to. Now, the definition of current assets is cash or assets that will normally be turned into cash in the next year or 12 months. So as we show it, it is things like cash and those kinds of things. Now, the program uses the cash pot concept when dealing with cash, checking account cash, and operating loan. So you can see that we're entering cash in the bank, checking account. In this case, it's at zero. And when we get to the liabilities page, you'll see under operating loan that we'll have an operating loan amount. So you're able to enter both cash and operating loan, but the program consolidates those things immediately after the entries are made. So just run through some slides here just to illustrate how this happens. So we have our cash operating loan consolidation. See the little pictorial of the cash pot. And the cash pot, again, the balance is the net of the cash and the operating loan. Going forward then, as cash comes in from things such as crop and livestock sales, new loans, capital sales, etc., those funds are added to the cash balance. And then cash goes out for things such as input purchases, loan payments, capital purchases, etc. So just to give an illustration, in our statement we had checking account cash at zero and we had cash saved at $15,720. But let's say that $15,720 was actually checking account cash. There's an operating loan of $241,600. And so in this illustration then, the net, the amount that would be in the cash pot, would be $225,880, which is the net of checking account cash of $15,720 and the operating loan amount of $241,600. So as mentioned, going forward then from this statement date, the ABA program will show the net. If the net is positive, it'll show as a cash balance. If the net is negative, it'll show as an operating loan balance. And when you get to the end of the year on the closing net worth statement, if the amount is positive, it'll show as cash. If it's negative, it'll show as operating loan. But in the closing statement, it won't show both. The next box in this section is the accounts receivable. Then going down again is other intermediate assets. And remember, we showed equipment on the machinery page. We showed livestock above. So this is other things, and it might be things such as an aggregate invest account that we've shown in this example, RSPs. It could be maybe a motor home or other personal things that are intermediate assets, maybe a boat or whatever could be entered in this section. In the bottom of this area is the other long-term assets, and that would be other real estate that isn't farmland. And remember, we showed the land in one of the previous pages, the farmland. So this might include things such as a commercial building or a house in town. So I gave you a definition of current assets above. Intermediate assets are assets that would normally be turned into cash in the time period of 12 months to 10 years. Long-term assets are the assets that have a longer life and things that would normally be turned into cash beyond 10 years. or they would be turned into cash or have a life of 10 years or more.